I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, are people freaking out now with the equity markets seemingly to have a lot of bad days between the good ones?
Well, I think it's very typical of humans that we get used to whatever present conditions have been. And so for a long time we had very reduced volatility with the QEs and the various interventions that were going on in the marketplace, since really 2010. When we had the flash crash in May of 2010, that was a very volatile period. But after that, we had a number of interventions that sort of smoothed out the bumps and kept pumping liquidity and sort of put everyone into a state of deep complacency with respect to volatility and risk in the asset markets. And so, we were jolted awake in February, if you remember, Jim, at the start of this year when we had an abrupt sell-off from a peak in January into February, and all of a sudden people were very sort of abruptly awoken to the fact that the stock market is a volatile place. And again, they've, had the same reaction in October. Now, interestingly, the retail crowd has been buying this dip. So this suggests to me that people are not actually that nervous yet. Retail crowd is typically the exact opposite of what they should be doing, whereas institutions have not been buying in this weakness. They've been using any strength days to sell, as have corporate insiders, which we've been talking about for a number of months. All year, corporate insiders have been, selling their liquidating their concentrated positions in company stocks in any period of strength, and indeed in months where there was buybacks going on by the corporations themselves. So we have this kind of very disturbing skew right now where we have a lot of support being broken, some very negative indicators suggesting this could be, the big one that has been overdue for a long time, but at the same time you have a retail complacency and money piling into, the ETFs and the passive funds still, even in down days. So that tells me that we're nowhere near, through to a period of panic or fear, and that we have probably significantly more downside risk here.
Is it true that a lot of the markets have lost all the value they gained since the start of the year?
Yeah, of course, and the TSX being negative year to date now. So, we'll see what happens in November and December. Typically those do tend to be, cyclically strong months where you get some inflows again. People sort of get through the October period and think, okay, let's reposition into year end. But we don't always see that. And if you remember, Jim, we saw, for example, in the 2008 cycle, markets peaked in June of that year and then sold off in the fall and continued to sell off into November and then had another relapse in March of 2009. So we could very well see that kind of pattern this year too. Just what everyone's expecting will usually get the opposite. So there's a lot of people that are very confident in seasonality patterns, and they're assuming that you'll get weakness in this October, but it'll rebound in the latter part of the year. That's not necessarily always the case, and indeed, especially when most people are expecting that. And as I say, when retail flows are still very complacent and not discriminating whatsoever, at the worst valuations that we've seen in 10 years, they're piling in. Just as, for example, the Canadian stock market, Jim, is finally, just under 15,000 where it was in May of 2008. So we've got a decade now of flat returns for the TSX from a peak valuation period in '08 to a peak valuation period in 2018, and now we're rolling over. So I put on a couple of charts this week of my partner Corey Venable's technical work which just gives you a big picture glimpse. Yes, we've had a rollover in the TSX. Yes, we've erased basically any net positive returns in that index for the last 10 years now, but people are still not really appreciating that the downside risk here is a retest of the '09 lows. And that would be a significant drop from where we are today, potentially from the 14 and change range into the potentially 8,000 range for the TSX. And what we're really noticing too is on the dividend paying stuff, on the, what's supposedly more defensive, that we've seen a lot of the losses come in the finance and dividend paying sector, both on an interest sensitivity response because interest rates have risen, but also because that's where a lot of the speculation has been going on this cycle, with people borrowing money, piling in, not paying attention to price. And so that's typically where you see forced selling when the down cycle begins.
We'll have more with Danielle Park right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, Canadian home prices are likely to go lower if sales don't pick up. Is that the case you see right now?
Yeah, so we had a couple of interesting reports out this week on the, first of all, on the luxury home sales market in Toronto and Vancouver, Jim, two places near and dear to our hearts. They said that they saw the Remax Realty Brokerage report said that in the $1 to $2 million range, which is almost like a standard property in those really expensive areas, the volume of sales was down over a third from a year ago in both Toronto and Vancouver. And I thought it was very illuminating that in the $2 to $3 million range, which is, considerably high end and out of the average person's sort of reach, we saw a drop of 50% in Toronto and 22% in Vancouver of sales volume again in that price range over a year ago. So, that would speak to, there's this notion out there that, well, people that have, affluent people are not impacted as much by interest rates. There's this sort of a theory out there that goes, well, a lot of the $1 to $2 and $2 to $3 million properties in particular are not financed, or that people are using cash. And the reality is that they aren't, that there's a lot of financing that has been going on in that sector. And indeed, at the margin, that's where a good deal of the foreign flows have been coming in to those higher end properties. So the curtailing of the foreign inflows with regulatory changes over the past year, as well as the rise in rates, which, let's not forget, does not impact just mortgages, but it impacts car loans and lines of credit and HELCOs and all these other types of credit which people have outstanding, and particularly in Canada these days. So it's just a function of the increase in cost and the less liquidity and availability in the marketplace of funding for these things that you ultimately see a drop in sales. And then traditionally when you see the drop in sales, the prices fall at a lag after that. So that's what I'm expecting. I'm expecting prices to continue to be under pressure over the next year and possibly longer. Typically when we've seen these secular periods where pricing in housing has got so far stretched away from affordability, I'm thinking about in the late 80s, the early 80s and in the early 90s, we thereafter saw a decade where prices were essentially flat or negative, very little gains made for a decade thereafter. And I think that, again, people have become complacent in the market we've been in, where rising prices were the norm for, at least the last 10 years. And then we get equal and opposite in the other direction very often in these periods. And I think that's where people are going to really be taken by surprise. We could potentially see both the equity market and the real estate market in a downtrend for an extended period. And that's going to be very hard on consumer balance sheets in all countries in the world, but especially in countries like Canada.
What happens when the mortgage you owe is worth more than the house that you hold?
Well, this becomes a problem on refinancing, right? And we've looked at that data in the past, how many homes are coming up for refinancing, in this year and in the next couple of years. And of course, with people that have so many HELCOs, which are indeed floating rate, typically lines of credit that people have against their homes. So it becomes very serious when property prices begin to stagnate and fall, because their perceived equity or what they thought they had in terms of net savings in their homes begin to evaporate. And then when you go to refinance them, you find that it's very difficult for banks to reapprove your mortgage when you have none or less equity than you previously did. And so it makes it harder for people to move mortgages, to go to different institutions. So very often it's a case where they have to try and sell the property to raise cash and pay down the debt. And when everyone is sort of in that crunch together, that again starts to be a very negative impact on pricing. So I thought it was interesting as well that we saw another Ipsos survey conducted on behalf of MNP this month come out that said that already with the interest rates to date, and we're talking still at very modest, relatively historically, very modest rates available in consumer credit in Canada, even with the hike by the Bank of Canada this week to a 1.75% benchmark rate. It's still very low, but already a third of Canadians surveyed are saying they think they may be having to file for bankruptcy, with the hikes to date. And so that just really shows you how ill-prepared people have been, how complacent they've been with debt, and how poorly they've managed the expansion part of this cycle. The boom phase, when everyone was, when we saw employment going up, we had this extended period since the last recession where liquidity was high, prices were rising, stocks, recovered, housing prices went up far higher than historic averages. And you'd think that after all that favorable condition for a full decade, which is a very extended cycle, you would think that people would be in good savings positions today, having paid down debt, having built up liquidity. Unfortunately, the exact opposite is where we are.
We'll be back with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking to Danielle Park. Danielle, if the markets are about to take a nice dive here, who will be ready to pick up the low-price stocks?
So this is the great tragedy of each cycle, is that the people who are giving the advice and doing the commentary and dominating the airwaves are in the business of keeping people long risk assets at all times. They are the broker-dealers, they are the financial advisors, so to speak, who work for the institutions that are selling the products and wanting people to stay in and not sell. So they very rarely ever suggest that anyone raise any cash. And in fact, you see today that the retail cash levels are the lowest they have been in many, many years. So people are fully in in terms of investing and whatever savings they have. And indeed, we know that margin levels are the highest they've been since 2000, indeed higher than 2000. So that means that not only do they not have cash on the sidelines to speak of, but they have borrowed to buy these assets, which means they will be forced to sell these assets as prices come down. We're already starting to see some of that. But as this continues, you will see that the people who are fully in, have little savings and are margined, are going to be in very poor shape and have, panic response as prices plunge, and they will be not at all prepared to buy as valuations present as the most attractive in probably at least the last decade and potentially the last 20 years. It'll be one of those opportunity sets coming. So it's only the people who prepare in advance, and that means the people who pay down their debt, who build up liquid savings, who don't have it all in the stock market and corporate debt, which is where the great risk is, who have the courage to leave those assets or at least pare them back and park money on the sidelines. And by that I mean in cash, in GICs, in liquid deposits, not in market assets. And it is those people, the few that do that in advance and wait for however long it takes for these prices to finally do their work to the downside. They're the ones who are in a power position when everyone else is panicking. And so it is an enormous opportunity. It is a great thing to do, but it takes you to push against the status quo and the market memes that are pounding us every day that, if we consider taking any money out, we're panicking or we're, being irrational, and all that is nonsense. So it really does take you to be, strong-minded and to have a plan in advance and to make your buy list in advance of the things you would like to own and just, do that work in preparation so that you're able to act when the opportunity presents.
Do you think that the higher interest rates, Canada has no choice but to go higher?
I think that they're in a, central banks are in a very adamant position today that they want to get some daylight between them and these record low rates because they know that no business cycle lasts forever, and they know they're going to have to cut and try and ease and try and, smooth out the downturn when it really takes hold. So they have been adamant that they want to keep raising rates. And the problem is they've left it so long. They really should have started hiking in 2011 and kept going instead of, kowtowing to markets every time there was a sell-off or a dip. They panicked and announced another round of liquidity. And so they really made a monster this time out of the banking sector, out of financial risk takers, all that. And so they are adamant that they want to break that sort of Pavlovian response and be strong in raising rates. So you get, people like Mr. Trump who are taking credit ridiculously for the advances in markets since he came into office, which were all driven by liquidity and risk-taking and nothing to do actually with him in office. And we joked before, Jim, I remember, about how he was taking credit, but as soon as the market began to tank, I was sure and confident that he would distance himself as quickly as possible from any responsibility for that. And indeed, he started this week talking about how Jerome Powell, the central banker that he appointed after Janet Yellen, has gone crazy. It may be his greatest risk and all this stuff because he's been raising rates. So it's certainly, the Canadian Central Bank wants to follow suit. They are, wanting to not be seen as having got way behind the eight ball and not raising rates sooner. Indeed, they did, though. That was a mistake in my view. And so I just think the problem here is going to be that as much as they want to get further and they want to get above 2% and they, see the potential to hike further, the great equalizer here is going to be the economy. And if the stock market and the housing market continues to exhibit weakness, if they continue to see people struggling to pay bills, if bankruptcy rates begin to spike, as they indeed seem to be doing now, there's going to be enormous pressure on them to not hike further and to go back to a bias of easing or neutrality. And I think that's very likely to happen in the coming months, where they won't get to hike as much as they've telegraphed and would like.
Danielle, thank you so much for chatting with us.
Thank you. Sorry about the rough voice.
Hey, you always sound great.
Thanks, Jim.
It doesn't matter how you sound when you say it. You always have good advice.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.